feel like I'm underperforming the market. I think one of the biggest challenges I see investors face is we see what an indice performs, the S&P 500 or some sort of broad-based market, and we think we want more. Well, in today's video, I'm going to show you how to build out your portfolio to make sure that you are maximizing the rate of return that you can get long-term. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm a former Major League Baseball player and the co-founder of Moment Private Wealth, a financial planning firm that specifically helps professional athletes and entrepreneurs build and protect wealth. And in today's video, I'm going to walk you through exactly what we walk clients through to help you determine not only how much risk you can take, but how you can further maximize your investment return in the market. So, starting out, what we need to understand is we need to start with two things. How much money do we have that we can invest? And how much money are we spending? Now, one of the biggest mistakes that I see individuals make, including the clients we work with, is we never talk about what we're spending. So if you don't know what you're spending, you need to figure out what you're spending first. In fact, everything I'm going to talk about in this video relates back to what you're spending. And I want you to think about spending into one of two buckets. You have your fixed costs and you have your variable costs. And I want you to frame it like this. My fixed costs, those are always going to be there. But those variable costs, I can either turn that dial up or I can turn that dial down. And I'm going to show you later in this video why it matters so much, not just to know what your spending is, but also to know what our fixed costs are and what those variable costs are. So when we think about investing, there's thousands of different things that we can invest in. But at the end of the day, they all fall into one of three buckets. And what I'm showing you here is exactly what we show clients. You can invest in these three buckets. Bucket one is what we would call our war chest bucket. Bucket two is our growth strategy, and bucket three is our aspirational strategy. And here's the difference between those three buckets. Bucket one, we are willing to accept a lower rate of return because we know we need this money and we don't want a ton of fluctuations with it. Bucket two is this growth strategy where we're saying, okay, it's fine if we have some level of fluctuation in it because we know that if we take on a little bit more risk here, our long-term rate of return is going to be higher than bucket one. And then bucket three is our aspirational bucket. For a lot of our clients, this is privately held businesses that they own. And for a lot of our athletes, this is private investments that they've made. We only touch bucket three if we maximize bucket one and two, and we can live our lifestyle on the money we have in buckets one and two. So I mentioned at the beginning of this video, I want you to be able to earn the highest rate of return possible. So how do we do that when we're thinking about these three buckets? Well, first and foremost, simply, the more money that we have in bucket two and three, and the less money we have in bucket one, the higher our expected rate of return is going to be. In fact, let me show you the numbers behind this. What you're looking at here is an asset allocation between, on the left-hand side, if you had 100% of your money in bucket two, and on the right-hand side, if you had 100% of your money in bucket one. And this is over about the last 100 years. And what you can see is with 100% of your money in bucket two, you earned almost 9.5% per year over about the last 100 years. And if you had all your money in bucket one, you returned just shy of 4%. Now, it might be easy for you to say, okay, Jacob, I know what I want to do. I want to have all my money in bucket two because I want to earn 9.5% a year as opposed to about 4% a year. And let me give you some actual math behind this. If we start with $1 million and we earn 9.5% a year, that's going to mean that we are going to be doubling our money roughly every 8 years. So a really good outcome. If we have all of our money in bucket one and we're earning roughly a 4% rate of return, that means it's going to take us almost twice as long, 18 years, to be able to double our money. So again, you and me both. We want to double our money faster. We want to earn a higher rate of return, but it's not so easy because remember, it has to go back to our spending. And the other thing I want to point out here is just because on this piece of paper, it shows you that you would earn 9.5% if you invested all your money in bucket two and you took on a little bit more risk, does not mean that's right for everybody. Because one thing I want to point out here is look at the swings in bucket two. The waves in the wave pool, the really good year is plus 30 something percent. The really bad year is negative 30 something percent. Those are big numbers. And I don't want you to just to think about them in percentages. I want you to think about it in terms of real dollars. If you had $1 million invested in bucket two and it went up 30%, that's $300,000. Everybody's ecstatic. If you had $1 million in bucket two and it went down 30%, you were down $300,000. Your $1 million turned into $700,000. That is a punch to the gut. And you have to be willing to stomach those ups and downs if you're going to have that much risk and have that much money in bucket two. So I've talked a little bit about why spending matters so much. And I want to articulate even further why spending matters and how spending will ultimately dictate what we recommend to clients in terms of how much money we have in buckets 1 and buckets 2. So what you're looking at here is 3 major market cycles over about the last 100 years. The first one being the Great Depression, the worst of them all. The second one being the tech bubble, and the third one being the mortgage crisis, which happened just in 2008. And what I want to show you is how long did it take for our money to go from peak to trough to peak again. So let's use our example. But let's say we have $5 million. And at the peak, we have $5 million invested. And that's exactly what this is showing you here. If we have $5 million invested in the Great Depression, and we have 100% of our money in bucket 2, our potential loss, or what the portfolio would have gone down, is about $4.2 million. A massive amount. But what I would argue is even more important than that is how long did it take for it to go from $5 million, lose all that money, go all the way down to the bottom, and then have the time to come all the way back. And what you can see is it's about 7.5 years. If you go over to the tech bubble, if you go over to the mortgage crisis, you're looking at somewhere between 3 to 4 years, depending on how aggressively you're invested. What you can see on the left-hand side is as we get less aggressive with the portfolio, as we have more money in bucket 1 over bucket 2, that time period shrinks a little bit. And the waves that we have in terms of the market loss that we have at the actual bottom of the market also shrinks. So I keep talking about spending. Why does spending matter so much? Well, in really simple terms, I want us to have as much money in bucket 2 as 1, we can stomach, and 2, we can afford. So by stomach, I mean, if the market goes down 30, 40, 50%, and we have that money in bucket 2, can we stomach that and not sell out of the market? That's a question that only you can answer. The second piece of that is, can we afford that? And here's where that spending aspect comes in. What I tell all of our clients is if we are spending money off the portfolio, I want to have somewhere between 3 years and 7 years in that war chest bucket or that bucket 1. And the reason being is it goes back to this page. If we had 7 years of money in bucket 1 and the Great Depression hit, we took $5 million, we put it all into the market. We took 7 years of spending. So let's say we're spending $200,000 a year. So that means we would put $1.4 million in bucket 1, and we'd put $3.6 million in bucket 2. So we have our $5 million invested, we have 3.6 in bucket 2, we have 1.4 in bucket 1. The Great Depression hits tomorrow. What happens? Well, first of all, it's not going to feel real good when you see the bucket 2 money dropping like a rock. But it is going to feel really good knowing that we have that $1.4 million in bucket 1. And the reason why that is going to be so powerful is if we think about this market cycle, roughly a 7-year cycle from peak to trough back to peak again, if we have enough money in bucket 1 to sustain our lifestyle for that entire period in time, yes, it's going to be a challenging time. Yes, it's going to be tough to get to. But the good news is you're going to get to keep living the exact same lifestyle that you were living previously because you're going to have enough money in your war chest to sustain your lifestyle. And that is why I tell you it is so important to know what our spending is. That's also why I tell you it's so important to know what our fixed costs are and what our variable costs are. Because the reality is what I also see for clients is it's great for us to talk in spreadsheets. It's great for us to talk about these numbers. It's great for us to talk about real dollars instead of percentages. But what's really going to happen in that situation is you're still going to have the desire to want to spend a little bit less. So in that situation, you have $5 million, you're spending $200,000 per year. You're probably still going to want to turn your dial back a little bit just to make yourself feel better. And what you're going to do is you're going to take some of those variable expenses you have. Those could be things like travel, expenses that you could always pull back on. Those are things that are not your house. They're not food. They're not groceries. They're things that we could actually pull back the dial on if we needed to. But the reality is, just like I said at the beginning of this video, my goal is to help you spend the most money you can, but also earn the highest rate of return you can. And it all goes back to what is our spending, and then understanding how much money we have in buckets 1, 2, and 3. Understanding what are we getting from a pros and cons standpoint in terms of rates of return, depending on how much risk we're taking. And then saying, okay, how much risk should we take? Or what I like to say is how much risk can we afford to take? And this all goes back to what our spending is. You want to have somewhere between 3 to 7 years of money in your war chest bucket if you are spending off the portfolio. Now look, this is different for everybody. We have clients that have upwards of 14 years in their war chest bucket. It makes them feel comfortable. My only rule with our clients and what I would want you to be thinking about is you do not want to have too much money in your war chest bucket that you can't afford what you have in your war chest bucket. And what I mean by that is If you have too much money in that war chest bucket and not enough money in bucket two, that growth strategy, you are going to earn a lower rate of return. You have to make sure that whatever that projected rate of return is based on the risk that you're taking is still going to be able to help you live your lifestyle in the future. One of the biggest mistakes I see, both for athletes and for entrepreneurs, an entrepreneur sells their business, an athlete comes out of a contract and they're moving on to their second stage, is they're saying, I don't want to risk something and I don't want to lose it. But the reality is we have 30, 40, 50 years to let this money compound. So it all goes back to the math and saying, okay, how much money do we have to have in bucket one? And then we have the ability to put the rest of that money in bucket two. And then it's up to the client to tell us, okay, what am I actually comfortable with? And it's our job to help guide them, to steward them along the way, to make sure that when we do have the inevitable market drop, because it is not an if, but a when, that it's going to happen, that the market will drop 20, 30, 40%. It will happen again. There will be another tech bubble. There will be another mortgage crisis. They will go by different names, but it will happen again. And you have to make sure that you can stomach it. As always, my goal is to help you get smarter with your money. And I hope this video helped you to understand how much risk you can take, how to even think about that, to better understand what you can afford and why spending matters above all else before you ever think about investing a dollar. Until next time, my friends.